First thing I'd say is that the ECB showed its determination last week to keep the European economy moving forwards through its asset purchase scheme and also through the targeted LTROs. We believe this will continue in 2015 to give some bedrock of growth to the European economy. Secondly, we think European equities still look very cheap relative to other global equity markets, particularly the US and Japan, and therefore international investors seeking exposure to the world growth and the world of market of opportunities, we think Europe is a good place to start. And then I think lastly, I think what we're seeing at the corporate level is the world of austerity in Europe is now forcing positive restructurings on companies and segments of European industry, and we think shareholders will be longer term beneficiaries of these restructurings. I think there are really three key strands to what is going on in Europe and why it is positive for European equities. The first one is that we have a very constructive European Central Bank. Last week they announced aggressive asset-backed securities and a long-term restructuring plan, and we believe that that will underpin a certain level of economic growth which Europe needs at this moment in time. The second thing is that we think European equities look very attractively valued at this moment in time, particularly against its peers in Japan and the US. And given that valuation is a key determinant in the returns to shareholders, we therefore think Europe looks attractive. And then lastly, what we're seeing on the ground in Europe is a lot of corporate restructuring. Corporate management has now appreciated that the rising tide of economic growth is over. They therefore need to focus on what they excel at and get rid of the excess capacity and the other diversified businesses that they manage. And that consolidation is really helping the growth prospects of most European companies. I think the areas of greatest uncertainty in Europe at the moment are also threefold. We have the situation around Russia and the Ukraine. I think there is no doubt this has been worse than we had anticipated, and over the summer months we saw the impact appearing economically in the recessions of France and Italy in particular, and the slowing of exports from Germany. So whilst this is likely to be protracted, I think at the margin it does affect the economic prospects of Eastern Europe and Germany and Greece in particular. So that is the cloud that we're clearly seeing on the horizon at the moment. The second issue that I think is bad news at the moment for Europe is the strength of the euro. Although in the last 3 months we have seen progressive, aggressive action from the ECB to weaken the euro, it has actually only declined 5 or 6%. And I think that really isn't enough in the world's competitive environment we sit in today to really see a boost to the economic competitiveness of Italy and Spain in particular. So we would still expect to see more and more efforts through the second half of this year for the euro to weaken a little further. And then I think lastly, but maybe not just a European issue, is the fact that many economies around the world now need fundamental restructuring. It's quite clear in Japan that we have not seen any Abenomics third arrow. We've not seen any credible restructuring in the US or in the UK. And obviously in Europe, Mario Draghi, the chairman of the ECB, is making it quite plain that he is doing all he can to support the current economic prognosis, but he needs more sign of restructuring and competitiveness policies from the EU and the relative governments. We're still waiting, and we're likely to remain waiting for a little longer yet. In conclusion, on behalf of European equities, they look cheap on a global comparison to all the other major markets. There's a lot of self-help and corporate restructuring underway, which we think will underpin both dividend growth and earnings growth for those companies concerned in the coming years. And I think importantly, with the recent fall in sovereign and many credit yields in Europe, European equities yield attractive levels, and therefore on a comparative basis inside the region look a good home for investors who are looking for income.